Hello, and welcome to this video on sole trader financial statements, how to show your workings for sole trader financial statements questions. Can I go through an example here? We've got 4 different types of workings. So we've got Abigail, who's a sole trader and has a jewellery store. It says show the workings for the following calculations of Abigail. First one, depreciation using the straight line method. So this is what we're told. Abigail purchased business property on the 1st of January 2020 at a cost of £350,000. Property is depreciated using the straight line method at a rate of 2% per year. Accumulated depreciation at the 31st December 2022 was for £14,000. And this is what we've got to do. Calculate the depreciation of property amount that will be shown in the income statement for the year ended at 31st December 2023. Then calculate the accumulated depreciation that will be shown in the statement of financial position as at the 31st December 2023. Right, so workings, depreciation of property. Now, in the income statement, your depreciation is the straight line method. It says here, straight line method. So straight line method is cost times percentage. So the cost, if I go back to the question, the cost was £350,000. And the percentage we were told was 2% per year. So it's going to be times 2%. So the depreciation of the income statement will be the £350,000 times the 2%, and that will give us an amount of £7,000. So that'll be in the expenses section of the income statement. So it's a depreciation charge for the year. Now it says calculate the accumulated depreciation that will be shown in the statement of financial position as at the 31st December 2023. So the accumulated depreciation is the depreciation from all previous years plus the depreciation for the current year. So the accumulated depreciation at 31st December 2022, I'll go back to the question, it was £14,000. That's our £14,000. Plus the depreciation charge for the year ended on 31st December 2023. We've just worked it out, and that is the £7,000 there. So that's plus £7,000. And 14,000 plus 7,000 gives us £21,000. So that'll be our accumulated depreciation in our non-current assets in the statement of financial position. Now that was done using the straight line method. Now we've got depreciation using the reducing balance method. So this time Abigail purchased shop fittings on the 1st of January 2020 at a cost of £45,000. Shop fittings are depreciated using the reducing balance method at a rate of 20% per year. Accumulated depreciation at the 31st December 2022 was £16,200. We've got to calculate the depreciation of shop fittings that will be shown in the income statement for the year ended at 31st December 2023, then calculate the accumulated depreciation that will be shown in the statement of financial position as at the 31st December 2023. So workings now. Depreciation of shop fittings. Reducing balance method is the cost, take away accumulated depreciation, times the percentage. So the cost, so back to the question now, the cost was £45,000. So in here, I'm going to put £45,000. We're going to take away the accumulated depreciation, and we were told in the question that was £16,200. So let's just move that. So that's 45,000, take away £16,200. That's going to be times the percentage. So back to the question for the percentage. The percentage was 20%. So we've got 45,000, take away 16,200, and that's going to give us 28,800. That's going to be times by our 20%. So the depreciation charge in the income statement will be 28,800 times 20%. That's going to give us 5,760. So it's going to be on the income statement, a depreciation charge for the year for shop fittings. That'll be in the expenses section. Now, statement of financial position. We want, again, the accumulated depreciation. So it's the accumulated depreciation at the 31st December 2022. So back to the question for that. We're told it was 16,200. So 16,200. Plus the depreciation charge for the year ended of 31st December 2023. That's what we just worked out. So that's the 5,760. So the total accumulated depreciation now at the end of December 2023 will be £16,200 plus the £5,760, giving us £21,960. Right, goods on sale or return. Now, a little explanation first of all what that actually means. So, goods on sale or return. So, an organisation gives some of its goods to another organisation to sell, but it does not charge them at the time of the transfer of the goods. It will only charge them for the goods if they're actually sold. If they're not sold, then the business returns the goods to the original supplier. So let's see what we got. So Abigail supplied jewellery to a customer on a sale or return basis for £2,500. The jewellery had cost Abigail £1,200. Now this is important. None of the jewellery had been sold by the customer at the year end. What adjustments need to be made to Abigail's accounting records for the year ended the 31st December 2023? Right, so when the goods were transferred to the other customer, she would have included £2,500 in her actual revenue. But none of these goods had actually been sold by the customer. So therefore she's got to deduct that £2,500 from her revenue because she hasn't actually sold them. Likewise, the trade receivables, again, the customer does not owe the money because they were not sold. So we deduct £2,500 from trade receivables. Now, closing inventory, Abigail still actually owns these items, this jewellery, and the cost of the items was £1,200. So that's the 3 entries you need to make for goods on sale or return. Now, the final one, provision for doubtful debts. Abigail's trade receivables, that's the amount due from credit customers, were £25,500 at the 31st December 2023. Specific irrecoverable debts included in the trade receivables amount of £2,500 were to be written off. So included in there, there's £2,500 that are going to be written off. They are specific irrecoverable debts, so we know what organisations or companies they relate to. After that, Abigail's provision for doubtful debts is 2.5% of the trade receivables. Last year's provision for doubtful debts was £400. So we've got to calculate the increase or decrease in the provision for doubtful debts that will be shown in the income statement for the year ended the 31st December 2023. So provision for doubtful debts then. So it's going to be our trade receivables less our specific irrecoverable debts. So it's going to be the £25,500. Take away the specific ones, and they were £2,500. Now, if there were no specific irrecoverable debts, then we would not be deducting anything. We just take the straight figure of the £25,500. But here we're told in the question there's specific debts that need to be excluded. And the percentage here is 2.5%. Now the percentage will be based on what's happened in the past. So how much of their trade receivables in general and in previous years did they not receive? So we now have got 25,500, take away 2,500, gives us 23,000. Going to times that by our 2.5%. So 23,000 times 2.5% gives us £575. That's the provision for this year in our provision for doubtful debts at the end of the year. Now, the last year we were told the provision was £400. So let's just put it in there for the moment. So that's £400. So that means the provision this year of £575 has gone up from the provision for last year. There's been an increase in provision for doubtful debts. And the increase is going to be the £575, take away the £400. There's been an increase of £175. Now that amount will go in your expenses section in your income statement. So that's a little video on the workings for sole trader financial statements. So thank you for watching.